The Bank of England has increased interest rates by 0.25. Now, this video will explain to you how this will affect you and your mortgage. I'll also explain some of the options that are available to you. Now it's at 0.75. Further increases are expected throughout the year, and some experts predict that it could go up to 1.25. Now, if you're on a fixed rate mortgage, this rate rise will not affect you until the end of your fixed rate term. If you're on your mortgage provider's standard variable rate or have a tracker rate, you can expect a rise in your interest rate. When the Bank of England's base rate goes up, it generally leads other lenders to increase their standard variable rate, usually by the same amount or close to it. Different lenders will do this at different times, some sooner than others. Now, an increase of 0.25 of a £100,000 mortgage is equal to an increase in your interest payments of £250 a year. Now, the three increases have led to an increase in 0.65 since December of last year. Now, this means that on a £100,000 mortgage balance, then the interest rate will have increased by the interest that you pay will have increased by £650 a year. Now, you'll have to work out exactly what this means to you, as different lenders' increases are different. Now, as I said at the start of the video, I would give you some options. So if you're on a fixed rate mortgage, as mentioned before, this rise won't affect you until that fixed term rate ends. However, when lenders give you an offer for a mortgage, this generally lasts for 6 months. So if your fixed rate finishes within 6 months or sooner, you can start to look at alternative rates now. If you do this, you could secure a better rate now and avoid the effects of future interest rate rises expected for the period you choose for your new fixed rate. There is a risk, however, that these rate rises will not happen. This is unlikely because the Bank of England uses the rise of interest rates as an effective strategy to curb inflation. To reiterate, you can start to look for alternative fixed rates for up to 6 months before the end of your fixed rate term. Now, speak to a qualified mortgage professional, preferably with a CMAP diploma, as they should have the experience to advise you and are more qualified than a CMAP qualified advisor. If you're on a standard variable rate, you can look for other options also. These could be a product transfer or remortgaging. Now, a product transfer is where you stay with the same lender but choose a different product that suits your needs. Remortgaging is where you move to another lender and get a better deal for your needs. You can choose a variety of different products, but again, speak to a qualified mortgage advisor because they can guide you through the process and advise the right product for you and your circumstances. As I mentioned earlier, some experts are predicting rises of up to 1.25 by the end of the year. If this is to happen, it would actually mean for a £100,000 mortgage balance, this would mean that you would end up paying an extra £1,150 in interest payments. If you are on a fixed rate mortgage with 6 months or less to go, or on a standard variable rate, you can look at your options now to avoid the higher payments from expected future rises. If you found this information useful, share it with others. And if you'd like to see more content like this, subscribe to the channel.